Well, good afternoon. Thanks for joining us today. My name is Rob Ferguson. I'm going to be hosting the webinar. We have a great panel discussion prepared for you on preparing for 2023 in the face of uncertainty. I don't know about you all that are joining us today, but for me and for our clients, I think these are some of the most turbulent and unpredictable economic times that I've seen in a long time, maybe even in my entire career. Some of our largest clients, and I even look at some of the most public companies that are very successful, I believe they're going to be tested these coming months and maybe even years with the changing capital markets, with interest rates, inflation, geopolitical issues, even supply chain constraints, I think are still here. There's many other things that are going on all at once. However, as we all on this call know, that it's these difficult times give us the greatest opportunity for business leaders to create new ways of doing business and creating new markets. I think about 2020, the beginning of the pandemic. That certainly was a time of uncertainty, but yet look at this venue that we're using today called Zoom conferencing. They thrived during the pandemic, but why didn't Skype thrive? What happened to them? Well, I think it really comes down to leadership. It comes down to leadership decisions or the lack of decisions. So hopefully this panel discussion is going to help you make better decisions as you get ready for 2023. So let me do a little bit of definition around terminology between the word business uncertainty and business risk. See, we believe at Ferguson Alliance, in the most simplest terms, that business uncertainty is an event that you don't know is going to happen. It's not predictable, and you don't have direct influence over it. Whereas risk is something you can measure. It's something you can predict. It's something that you can decide to take action on or not. So we know that business leaders like you all listening today have challenges managing risk. It's what you do. But uncertainty is even a level higher than risk, I believe. So today, we're going to be talking with three experts about business risk, business uncertainty, and hopefully, I think, business opportunity. So again, my name is Rob Ferguson. I'm founder of Ferguson Alliance. We're a boutique business advisory firm. Our client base are small, middle capital market owned businesses, all family owned businesses. We provide guidance with business value growth, succession planning, and family business governance. So joining me today is Ali Nasser. Sorry, I'm also navigating the screens. Joining me today is Ali Nasser. He's founder of AltruVista, an independent wealth advisory firm specializing in advising business owners and their families. He is also the author of this great book, and I have it right here on my desk. I'm going to give you a plug, Ali. This is a terrific book. It's called The Business Owner's Dilemma.
Thanks,
and it's a great, it's well written, but it's a really good roadmap for business owners that are trying to balance decisions between business, wealth, and just life itself. So anyway, Ali, thanks for joining us today.
Thanks so much for having me, Rob.
You bet. It's also a real privilege to have Walter Tomlinson joining us. Walter is co-founder and principal of Statesman Business Advisor. Walter and Will Jaco co-founded Statesman back in 1998, so they've been around for a while. And what's really terrific is most of you on this call have heard of Statesman. They have developed a great reputation as the go-to investment banking firm for mid-cap founder-led businesses. Walter also, he'll be able to add to this conversation. He's had 30 years of hands-on experience as a operations leader and a sales leader. So Walter, thanks for joining us very much.
Glad to be here. Thank you.
And then we have Jared Grabow. He's Senior Vice President of Sunflower Bank. He's also the lead for their Texas business development. I've known Jared for quite a while. We've looked at some deals together. He is a asset-based and specialty finance lender. You don't know, maybe Sunflower Bank is probably not a name that you hear very often but you will be soon. I guarantee you, because I know Jared and his efforts that he's doing here in Texas. Sunflower Bank, I'm going to promote them a little bit because I think this is a great bank. They were founded in 1892, and they've been around for a long time. They've got great experience. They're headquartered over in Denver, Colorado, but they are probably the fastest growing community bank that you'll know. They've got over $7 billion of assets. And I think with Jared and his team, they're going to soon be known as one of the finest regional banks. The other little tidbit of knowledge about Sunflower Bank is they're family owned. And the clients that I've introduced Sunflower Bank to have really appreciated that fact that it's also family owned, as Ferguson Alliance works strictly with family owned businesses. So that is our panel, and that's who we're going to be having interviews with. And so glad to have you guys here. Just to let you know, we do have some prepared questions. They're right here in front of me. I'm going to be reading a few, but we want all of the participants to engage with us. So we may not have the best questions. I've got a couple to just get it started. Brandy Merrick is a colleague of mine. She is going to be monitoring the chat room. So we all know how to do this now. Go to the chat box, type in your question, and Brandy is very good at interrupting me. Even when I don't want her to interrupt me, she does. So she's got a really great skill with that. And she'll get your questions inserted into our conversation. So with that said, I'm going to go ahead and stop my screen sharing. And we can just go right into our questions. So Ali, I'm going to start with you, sir. In fact, right before this meeting, I was listening. I had a business news show on. It was about 20 minutes ago, and they were talking about, is this a bull market or a bear market? And they were debating, and it just seems like that the capital markets have become very polarized, and I wouldn't know how to define it. I don't know. So you're the expert here. So you tell us with the current, what is the current state of the economy? What's going on in the capital markets? And then as for our audience, what should we be expecting going forward?
Okay, wow, loaded question, but I like it. So I'll give a brief history of what's happened this year, because I think context is really important. Starting out 2022, everything was priced to perfection. Capital markets were at all-time highs, real estate prices, private equity prices, all asset prices essentially were trading near or at all-time highs. And in the early part of the year, we received some new data around inflation that was not expected. Essentially, while much of the market thought, hey, inflation could kick in with all this stimulus and low interest rates for such a long period of time, the Fed kept saying, inflation's under control. And a combination of the supply chain, a ton of stimulus that happened with COVID, sustained periods of long sustained periods of low interest rates. You get a combination of all of this, and what ended up happening is we saw a spike in inflation. And when the Fed saw this spike, their action that they looked to take was we need to raise interest rates and slow down the economy. And for those of you that aren't as familiar with interest rates, when interest rates are being raised, it's essentially like pumping the brakes. When interest rates are dropped, it's like hitting the gas. So we've seen almost, actually more than a decade of near zero interest rates. And all of a sudden, in a short period of the past 7-8 months, the Fed went from near zero on interest rates up to 4% on interest rates. And what happens is interest rates heavily impact the value of asset prices, whether it's real estate, stocks, bonds, everything gets affected by interest rates. So when the Fed raised rates due to the spike in inflation, all assets have to be repriced. So the assets that get hit the hardest are your high-flying growth stocks. So your DocuSigns, your Teslas, your companies that may have a very high price to earnings multiple, those asset prices tend to come down a lot. So we saw tech fall, at its peak, close to 40-50%. The S&P at its peak down about 30%. And this battle that's now happening, where you talk about the bulls, is it a bull market, is it a bear market? What's happening right now is market participants are trying to figure out, is the future better or worse than what we currently expect? So the stock market tends to price what's going to happen 6 to 12 months in the future. So right now, all available information, the market's pricing in of what's going to happen in the economy in the next 6 to 12 months. So will inflation continue to rise, or have we seen it peak? That's the big question. And if inflation indeed has peaked, we may see this being close to the bottom of the market and an uptrend in equities from here. If the data becomes worse and inflation's worse than expected and continues, and this is not the end of the spike, then we could see further declines in the marketplace. And that's the big question right now as to what the data is going to show in the future, and are we past the worst of it with respect to inflation? If we're not, Fed's going to have to continue to keep rates high for a longer sustained period of time, and that will negatively affect asset prices. But we've already seen a large part of that priced into the market currently.
Okay, great. And I'm going to circle back to you on that point. What do you do? How are you advising your clients? But before we go there, I want to turn over to Walter. Based on the backdrop that Ali just talked about, what's going on in the economy and specifically the capital markets, how are you advising your clients today? I mean, it's definitely been a seller's market for business owners that have been wanting to monetize and exit. We have a lot of business owners that are boomers and they're ready to exit, and we help them plan for that. And then you obviously help them execute on that. So how are you advising your owners today? Is this a great time for them to sell their business, or is this something they should wait?
Well, great question, right? And as Alec talking about, if all of us had the crystal ball to know, you would know. But in lack of a crystal ball, you have to really kind of look at each one. I mean, I think without trying to be too simplistic on this answer, there's no one case that fits all of those situations. So there have been some companies that in some industries where the hike in interest rates have had a significant impact. Companies that were tied to home building, for example, have been hit. That the home building industry is kind of moved hard. So building products, things along that line, where the impact has been significant and earnings have been come down. Obviously, in those cases, you're probably pausing on your plan to go to market right now and you're letting the market settle down to see where they can go. Other markets where they haven't been impacted, we're still going to market on those companies. We've got multiple markets in the company, multiple companies in the markets right now. And deals are still very much getting done. We're probably have three to four companies that we're in process to get closed by the end of the year, and looking to launch several processes going forward. So it is not a case where there's a general, we've got a yellow line up or a red light up to not go to market. But it's very, very, very much a case by case basis that we're kind of advising on.
Okay, I'm beginning to get a theme here. I mean, you sound a lot like the news commentator that I listened to, and then Ali was talking about, well, it depends, and what depends on what industry you're in. So it really is a time of uncertainty, right? Depending upon what sector you're in, what's going to happen with the Fed rates. I'm interested, Jared, how you think about this now as a commercial lender. And my clients, those that don't need money don't want to come talk to you, but then those that do need money want to come talk to you. And so how are you looking at the credit markets today? And particularly, it'd be very interesting, what are bank credit committees thinking about going forward with interest rates as well as lending?
Yeah, well, thanks, Rob. I think in 2022, when we look back on it, we'll probably call it the year of the two big fears, the fear of inflation and the fear of recession. And, interest rates have increased. I think The interesting thing during the pandemic is people were pretty flush with cash, and they had that money. Cash was king. I read a note that there's 33% of a record high of personal savings rate during the pandemic. So, people had the liquidity. Now a lot of those savings are dwindling. And I think that's one of the reasons we've been kind of buffered from that recession to date. But we're coming to the edge now, where the savings are going down, that cash and that liquidity is going down.
Yeah.
So the question is, if you're in personal finance, what do? You try to get more credit cards, you look at a HELOC on your mortgage, you look for liquidity. So businesses are thinking the same way. They're starting to say, do I have enough kind of cash for a rainy day over the next 6 months, a year, as we come what could be a formidable recession? So I think you're seeing credit committees pay attention to that. Anything that's really tied to the consumer is getting a lot of scrutiny right now. I also think people are really worried about where's that liquidity position over the next year. So those are the two things that I'm hearing the most. Also, I think, we see a lot of the larger banks like Bank of America, JP Morgan, they're starting to take the reserves now. So I think the article came out there in the multiple billions of dollars. So they're seeing next year's potential challenges coming. So it should be interesting what we're facing.
So hold on to your hat.
Yeah.
Okay, I get it. So coming back to you, Ali, when you're advising your clients right now, particularly in a time of high inflation, where's the best place for them to park their capital during this time? In fact, I have my son and my daughter, they're calling me all the time. What should I do? What should I do? So you kids don't have enough money to do anything, so you're safe. Don't worry about it. But for your business owners, I mean, where's the best place to go during these high inflationary periods?
Sure. Well, so I think you nailed it there when you started with for your business owners. So the majority of our clients, their best investment's their business. That's their primary investment. So what's made you successful in growing your company is whether you had a recession, whether you had inflation, whether you had expansion economically, whether interest rates were high or low, oil prices were high or low, you continue to stay invested in your business. And that's what brought you to the success that you have today. No business owner bought and sold their company because of economic times. Say, it's a bad time to invest. It's a good time to invest. Let me sell my company or get back in. Business owners are successful with their wealth because they continually stick to a long-term plan of building their company. They don't get distracted by the noise. In a similar capacity, investing in public markets, if that's the investment you're discussing here with equities or the stock market, it operates the same way. Right now, asset prices are depending on what asset you're buying, 20 to 30% lower than they were in January. If you're invested for the long term, and this is not capital that you need for your company, this is not intermediate term capital that you may need for expansion for your business, or as Jared alluded to, liquidity capital for your company, and it's truly long term, my guidance is to add additional exposure to equities in times like this. And the reason I say that is when you're looking at an economic environment that's highly inflationary, if you look back over history, the assets that did the best in high inflationary periods were equity type asset classes, not cash. Generally speaking, cash is deteriorating to inflation because there's no upside in cash. And if the US dollar is to weaken, which there's many expectations of that in the future, given the sustained strength that it's had, you could have a further hit to your dollar. So in times like this, first and primary, business owners need to have enough liquidity to meet their business needs. At a base level, 2 months of operating expenses should be in the bank. And it may be higher than that depending on their company. The second thing they need is liquidity to weather the storm. So usually in times of, if there is a recession, if we do hit that, which we're pretty close to it, and it's highly expected to happen in 2023, if that does happen, that can be a great time to reinvest back in your business. So having a pool of liquidity and identifying what are the 2 to 3 top business reinvestment opportunities that you may have, and saying how much would those opportunities cost, whether it's hiring another team member or expanding a facility or buying a piece of real estate, how much capital would I need for business reinvestment? That's the second area you need to take capital. So again, liquidity, minimum 2 months of operating expenses. Second is your expansion capital. Anything beyond that short-term and intermediate-term liquidity, you want to be looking at opportunities to invest that capital long term in a place that's going to outpace inflation and deliver a good return and be a good store of value. There's equities, there's real estate. Those are the main asset classes in your own company. Generally speaking, fixed income or bonds aren't going to deliver a great long-term return. You can certainly park your cash in US Treasuries and make 4% on your cash. So that first and second bucket I talked about, that could be parked in cash, making 4% in Treasuries and not have any risk. And the excess capital, I would highly encourage in times like this, when people are fearful, like Warren Buffett says, when people are fearful, you can get greedy. And right now people are very fearful. And if it's really long-term money, I'll be very specific with this. I do believe this is a good time to take that excess capital and put it into equities.
Yeah, yeah. Well, I do like your advice about investing it back into your business. In fact, for our clients, I think we looked at this at one time. It's been a while since I've looked at it, but over 85% of our clients' average net worth is in their business. It's not in other asset classes. It's in their business. Right. And so I think that's some good advice. I'm thinking though, you're talking about, hey, make sure you got plenty of liquidity. I'm going to turn to Jared and talking about liquidity and thinking about this. You know, we have some clients that you know, are very fortunate. They don't have any kind of revolving line of credit or really any debt to speak of. Would this be a time for clients with that type of a balance sheet to come talk to you to talk about maybe looking at a line of credit as we start thinking about some of the uncertainty going forward into next year?
Yeah, thanks, Rob. I think it's always a good time to come talk to us. And I think especially kind of as Ali was alluding to, for companies with strong balance sheets, now is really the time to think about offense for how you can improve your business, maybe some add-on tuck-in acquisitions. It's a good time to have a good balance sheet. So along those lines and talking to a bank, you can really see what your options are in terms of liquidity and how you can expand your footprint, how you can expand your product lines, and to be thinking along those lines. So sometimes companies aren't in that position where they're in that strong balance sheet and they're playing more defense, and we can help there too. You know, sometimes they have assets that are unencumbered that haven't been leveraged, and you know, they could get liquidity that way. So we really kind of start with what they need and where they're at and what they're trying to do and try to build a solution from there.
Great. And then Walter, Jared talked about interest rates rising. How does that affect your world? As interest rates are rising, is that impacting the valuations on the businesses that you're advising? And do you think these higher interest rates, are they going to slow down the deal flow, or do you remain bullish about deal flow?
Well, let's back up a little bit. Deal flow has slowed down. Deal flow in 2022 compared to 2021 is down. You know, different reporting kind of mechanisms, but you know, kind of anywhere from maybe 20 to 30% in terms of volume from last year. So when you are, as every kind of when is alluded to, I mean, we are in an environment, as you talked about, of uncertainty, right? And so highest inflation, supply chain issues that are coming back, higher interest rates, and in the world situation. So this is first and foremost on everyone's mind. You know, buyers as well also. But as I said, that the peak that it came down from, being down 20%. The peak that it came down from, there is still a tremendous amount of activity that is going on. So if the question specifically about interest rates and does interest rates impact valuation, the answer to the question is yes, it does. I don't think you can answer it that it doesn't. There's no impact to it. But unlike when you're making a comparison against interest rates where the housing market really dramatically fell off because of a high interest rates as it relates to the leverage on business acquisitions are not nearly, you're not lending 80% or 70%. So it's a smaller portion of the leverage that goes into the transactions, and it is making an impact, but it's not making it. I would say, we characterize it. It's not making enough impact where it's kind of a deal killer because of the impact of the interest rates on that. I think that some of the other just combined uncertainty that's going on is just prudence in the market, slowing down in the market. Some of the volume is alluded to your earlier question about, is this the time to go to market? And kind of sellers kind of making the call to kind of hit the brakes a little bit and go into market. So it does have an impact, but not singularly on the M&A market.
Okay. All right. Good.
I would add one of the things that. So I was just going to add one other thing. There is a little bit larger transactions. I think it is having more of an impact because I think there's a tightness in the market that's going out. So when you're looking at, we're in market now with a company that's probably going to be north of 50 million in EBITDA. And so the financing on that and having the lenders and doing that is definitely more of a discussion that's going on. But typically lower middle market, private equity based investments, folks are kind of finding a way to put a little bit more equity into the situation, maybe finance out later, so less of an impact.
Yeah, understood. Ali, you had a comment you wanted to add.
Yeah, it's just a question for Walter, kind of a cross question for Walter. We've seen public equity valuations fall substantially this year. Like price to earnings multiples have come down quite a bit on public companies. And I'm assuming that the customers or the sellers that you represent, some might sell to strategics that might be private equity strategics, and some of those strategics might be public companies. Have you seen the same or similar levels of valuation decrease in the private market? Like, how would you compare private market valuations to public market valuations as far as how much have they come down this year in the private market versus the public market?
Again, that's a great question. And again, there's a big disparity just between the public and the private markets, and primarily from a liquidity standpoint, right? Just how quickly things can move and how quickly things can go up in that. But there we are seeing, so it's hard to equate valuations, coming down as a percentage, but I think I can talk in terms of just relatively speaking that, kind of some, kind of stick figure type things that typically valuations or a formula for evaluation that's very common is a multiple of EBITDA, of a multiple of companies' EBITDA. And so again, depending on the size of the company, depending upon which industry you're in, you can have, it's going to establish the multiple kind of range for privately held companies. Again, we are seeing there, I would say 22, 21, 20, you were without question seeing peaks in multiples of EBITDA that we're paying, and where historically kind of an above 10, a 10 multiple on an EBITDA, kind of in a privately held company, was kind of rare unless it was a kind of a technology-based companies, and you were seeing those coming out. So I would say that those have moved down. I would say maybe, kind of 1 to 2 turns on average. So it's not kind of as frothy as you was, but again, particularly when we're talking about clients, and you've got to balance that out there between doing that. While everybody certainly wants to optimize the value of the business, and that's a fundamental drive in being able to do that. And that gets back to, getting a 9 multiple for your business versus getting kind of a 7 multiple for your business, which has been a, there's a question of value there, and a question that gets back to that kind of motivation again, where each one is different, and you've got to look at it. Why is someone selling? Are they selling because they have to? Are they selling because they need it into? So there has been an impact, but Ali, again, I just think I guess the continued message that I say there, it hasn't been an impact so much that it's just a stick has been stuck in the spoke of the wheel where things have shut down or there's just a red light going down there. But in fairness, if people are comparing it to their frothy peaks, we're not seeing the frothy peaks right now.
Well, let's see if we can find some opportunities. We've been talking about risk for sure, and I think we've spent quite a bit of time talking about uncertainty. I think we're all convinced it's uncertain times. What opportunities could exist, Jared? I'm going to go to you. In a down cycle for business, what would you see are opportunities for business owners in a down cycle from your perspective?
Well, the obvious one is there's going to be some companies that stub their toe, and several that kind of with their banks have kind of moved on or want to move on. And there could be opportunities to bring them in the fold and make an acquisition. I have a lot of friends that are in the turnaround space that haven't been very busy in the last couple of years, and they're starting to get pretty excited. They're on the sidelines and their phones are starting to ring. So I think that means opportunity for the companies that have stayed prudent over the last several years, have the right type of balance sheet that they can reach out and it's going to mean a lot of businesses that get sold, should be keeping Walter busy more on the distress side versus the frothy side. So I think businesses that have the foresight to see this as a time to grow, it might be a good time for an acquisition, but more on the distress side.
Yeah. Okay. Ali, for your clients, what are some opportunities that you're seeing ahead in 2023?
Yeah, I think that there's several. I'll speak to the top 2 or 3. So first, with respect to long-term investment capital, whether you're investing back in your business or you're investing in other asset classes, I think anytime you see a big decline in asset class prices, there's an opportunity for long-term investment. From an estate planning standpoint, we kind of have the perfect storm right now. When Trump was in office, he doubled the estate tax exemption, which, just to explain this in simplistic terms, let's just say you're a business owner and your total net worth, your wealth, your investments, your business, your real estate, everything together, let's just say it's $50 million. And when you pass away, or when you and your spouse pass away and you leave those assets to your children, there's currently a 40% estate tax. Now, before that 40% tax kicks in, there's an exemption. And the exemption, after Trump doubled it, is approximately $12 million per spouse. So essentially, the first $24 million of your wealth that passes to your children, 0 tax. Then, in this case of $50 million, the excess, the $26 million excess, would be taxed at 40%. Now, this estate tax window, or this estate tax exemption that's been doubled to $24 million, it gets cut in half at the end of 2025. So that's going to go back to $12 million combined between 2 spouses. Now, if you're worth $50 million and everything over 12 is going to be taxed at 40%, that's a huge issue, especially if you're illiquid. As you mentioned, 85% of your clients are illiquid and their money's invested in their own company. So the planning opportunity that exists right now is asset prices have declined in value. And if you were to value your business, likely you could argue a lower valuation on your business because of the economic uncertainty that we're in. And this could be an opportune time to potentially look at doing some estate planning, gifting or transferring assets to your children or to trust in a way that you still control the business, in a way that you still have the income that you desire and the control that you desire, but starting to think strategically about how do I minimize the tax that I'm going to pay over my entire lifetime and the wealth that I pass to my children. So we're in a unique situation where the estate exemptions are really high and we have only a couple of years. Washington is somewhat in gridlock, so we don't think there's going to be any major change in the next couple of years from a policy standpoint. And asset prices are low. So this might be one of the last windows that we see to do complex estate planning and potentially save business owners' estate multi-millions by doing some intentional planning. You can spend thousands and do intentional planning and potentially save millions. And I think that's one of the biggest opportunities that exists for business owners in the current environment.
Very nice. Yeah, that's a big opportunity. So, Walter, for your clients, what are some of the opportunities that you see in these turbulent times for 2023?
Well, I think that just getting prepared, so I'll switch a little bit. So as you alluded to, we have been advising on this transactional process, transferring your business owner for 27 years within Statesman, doing this. And so from that time, you look for some commonalities in this, and then I would say certainly more often than not, I think as business owners are thinking about going to market, I don't know that there's a full appreciation for the value of kind of really getting prepared and not just, okay, I'm thinking about going to market. How quickly can you get a confidential memorandum together? How quickly we can get to market? But the difference between, really getting prepared and to go to market and, kind of rushing to market unprepared, again, can be meaningful dollars, really meaningful dollars. So I think if the decision is, if one is and has that situation where they are in the window, maybe generational kind of retirement planning, that they're thinking about selling their company within the next, kind of 12, 24, 36 months, economic situations doing, there's not something that just hits the red light and everybody quits. Then I think, working with firms like yours or Ollie's, and certainly our firms of doing that, spending that time talking to the investment banker. What does being prepared mean? What do I look like right now? I think, Ollie had a great point, right? That you're spending a little bit of money on preparation, relatively speaking, to saving millions of dollars. And I think that same sort of logic could be absolutely true. Spending a little bit of money to allocate and get prepared and understand what that means and how to get ready. What can I do? How would my company be viewed by a buyer? What are the areas I can do? I think that those would be just terrific objectives for companies to do in this turn, as it turns out to go back into.
Great. I want to add an opportunity from my perspective. We've been really honing in on the capital markets and economy and kind of financial opportunities, but it'd be interesting to hear how you all react to this. But there is a very major talent war going on right now, and I am baffled by our low unemployment rate, and I don't know what happened to all the people right before COVID. I mean, everybody had jobs, everybody was, our productivity nationally was up. I mean, things were going great. Now we had the pandemic, and now our local restaurants can't find help, our warehouses can't find help, we can't find truck drivers. It's baffling to me. And as we work with our clients, they're constantly struggling for talent, to recruit really good talent. And then, they've been really focusing more on retaining talent. And so I think the big opportunity, bit beyond some of the financial issues, is just taking advantage of bringing in great talent, recruiting good talent. And we are finding that talent today they're wanting to work with a company with purpose. And Ali, I know you even talked about that a little bit in your book, but it's no longer, I just want to come to work, punch my clock, and get out. Even our tradespeople that are working on the warehouse floors or on the manufacturing floors, they want to be with a company that they're proud of being with, that has a purpose, that they're making a difference. And so I would just say to those listeners here, as you prepare, is it really does start with the culture of your business. And if you can have your business culture kind of be haphazard or unintentional, and I think you might struggle with your talent. But if you are very intentional around creating a culture that's centered around your company's purpose, that's really has your family values integrated into your business value system, you're gonna be a magnet for great talent. And I would say preparing for 2023 is make sure you've got a good talent performance plan in place for recruiting, for retaining, for compensating, and for training, and be very intentional on that. And I think the money will follow, in my opinion. Let me take a pause, and Brandy, I'm going to look over at you. Do we have any questions from our audience as we're starting to near the end of our conversation?
We do not yet, but I have faith that someone's going to come through with some good questions.
Okay, yeah, so it's anonymous. We won't call you out. You just type in your question. And these are all three brilliant guys, and they cost a lot of money professionally. So this is time you get free advice. So go ahead and type in a question.
Well, I can chime in on what you just mentioned while we're waiting, Rob. Because
sure.
I've been in business 20 years. I have never seen or heard of a situation that we're dealing with right now with the employment talent shortage, the issues that we're dealing with today. It is unprecedented. And to my understanding, really in US history, we've never seen the types of challenges we're facing with the labor force. And we work intimately with about 100 different business owner families. And I was talking to the restaurant owner the other day, and he said, I've got people coming in for interviews saying, I want more work-life balance. I need to have these days off. And it's not a function of $15 or $18 an hour. They're saying, well, I can make $25 an hour driving for Uber. So why do I work here? And that's at the restaurant level. And then you might have at the level for professional services company, it might be that, well, now I want a different hybrid lifestyle, and I want to work less hours and make just as much money and have longer term incentives tied to the company. And now I want equity as well. And the percentage of our revenue that is being consumed by labor is getting pushed higher, and higher.
Mm-hmm.
And there's a point to where that transfers over, and a business owner has to say, well, in order for the company to remain profitable, I've got to essentially really increase prices, because all of my labor force is wanting more money and more time off. So there could be an increase in productivity. It could be neutral, but it's a tremendous issue because the net result is the business owners forced to raise prices, or in some way, shape, or form, which is, again, it is supportive of further inflation, because once producer price goes up, consumer price goes up. So this is a major, major issue. And I don't know if there's anything more concerning for business owners as a whole right now than this talent or employment issue.
Yeah, I agree. Totally agree.
Okay, we got one question.
Okay, go ahead, Brandy.
Ready for it? Okay. How should family businesses define, calculate, and monitor their liquidity?
That's a great question. That's a really good question, and we're going to get it from three different perspectives, which is going to be terrific. Ali, I'll start with you, and then Walter, and then I'll end up, Jared, with you. So
sure,
I'll let you go first, Ali.
I appreciate it, Rob, and thanks for the question, whoever submitted that. There's actually a chapter in the book on liquidity and cash flow for business owners, and defines exactly how to calculate these things, but I'll give you the Cliff Notes version. Essentially, I divide it into three buckets. The first is, what do you need in the next 12 months, your working capital for your company, expenses that are planned, operating capital, reserve cap. What do you need for the next 12 months to operate your company effectively? And essentially, what's that target number? At a base level, 2 months worth of operating expenses should be that floor. And depending on your business, it might be higher than that. And you might want to discuss, you as the owner or potentially with your CFO, and say, if we saw the worst case scenario happen with a recession, and we had the levers that we can pull, potentially reducing expenses or focus on increasing revenue, whatever it may be, what's the most amount of capital we might need? And that's a very important calculation. You want to have that money sitting in reserve capital in the bank, or sitting in treasuries, earning some yield. The second amount of liquidity you need is intermediate term capital, which is looking not at the next 12 months, but the next 1 to 5 years. And what capital might you need for expansion to either capture your biggest opportunities or solve your biggest issues. So if you've got an issues list or an opportunities list for your company, identify those top 2 to 3 issues and opportunities. How much money might you need for that capital? And that should be number 2 for your business liquidity. Have that in reserves or have that available through lines of credit or through loans. And Jared kind of alluded to it earlier. It's better to get money in advance of needing it. So have that second capital. And then anything beyond those first 2 buckets of liquidity should really be allocated to long-term investments. You don't need to have more liquidity than you need. And where you park that capital is primarily a function of in the bank or in treasuries if it's money you need. And you might be able to have a low risk portfolio if it's money you might not need in the immediate future.
Great. And those are the cliff notes and the chapters in here. Thank you.
Sure.
Walter, how would you define that?
Well, you know what, I think that from the question and how you calculate it, I don't have anything to add to that. I thought that was very good and very, very straightforward on that. Certainly when we look at liquidity, again, it depends on the thing is we're taking somebody to market, kind of, again, in the healthier company, the working capital they have, establishing that the liquidity is important. Jared, you were talking earlier about, the distressed M&A world who've been sitting there, and we've got a company that we work with out of Philadelphia that we kind of have worked with and partnered with on transactions and similar type things, and always kind of joking them and describe them that what they're taking companies to market where some other constituent has made the decision that they need to go to market, as opposed to the owner going to market. And so typically that might be, as Jared said, it might be the bank that's coming in there and said, we've had as much fun as we can take on this and going to market. So, I think all of those are in there. I mean, that those things about being in there, you are in control of in control, but got another colleague that works with us says, the banks, there's lots of people that own your company, right? The banks, your vendors, your credits, your creditors, and they do have a say-so. So I just think that, again, during this time, keenly monitoring that, where your levels are really important.
Very good.
I would just add to that just a few small things from a banker's perspective. We think about liquidity, cash on the balance sheet, availability on your line of credit or revolver. But we also think, working capital, cash conversion cycle, what your payables are versus when you're getting your receivables, making sure that you're adequately prepared for that, your CapEx needs over the next year, that you've got enough for that. And then the other caveat is you might be a fast grower. So if your company is growing quickly, you'll need liquidity even, it's even more important to you as you're increasing your receivables and you're not getting paid, but the money needs to come now. So I think in that part, it depends a little bit just on where your company is based, but that's really what I'd add from a banker's perspective.
Yeah, I'm really glad you added that part about growth. A lot of our clients, the business leaders, don't understand at first that it takes money to grow. I mean, it just cannot be aspiration. And we have a saying around here that we share with our CEOs of businesses: you can't outrun your cash, you can't outrun your people. So you got to plan for it, right? You got to understand that. That we'll move on to some other questions, but there was a third part to that question I'm not sure we really talked about, so I'll just talk about it, which is monitoring. How do you monitor that, and how often should you monitor it? Well, one of the things that we do, and we work with our clients, is we install or help our clients install a system for managing, which does require, frequent monitoring of certain key performance indicators, whether they're financial or non-financial. But we like to look at that liquidity formula that Ali mentioned monthly. I mean, that's how we're constantly monitoring that. And it may not change too much, but we have some businesses that are highly seasonal, and that's where we have to really stay on top of it. So I do think that third part of the question that was asked about monitoring is really important. And unfortunately, we have some clients that they never look at their balance sheet. They look at their revenue. They might look at their bottom line, but as you know, in their mind, as long as their revenue is growing, all is good. And yeah, high growth rate in revenue can overshadow a lot of sins in a company. But I would say going into 2023, if you've experienced double-digit growth over the last, let's just say, decade or half decade, what got you here today is probably not going to get you to where you want to go tomorrow. So we've been even advising our clients to do 3 scenario plannings, kind of low case, real case, and a high case, just to really think thoroughly about their business. And I love that question. So Brandy, you've got some other questions here. We got about 5 minutes.
Yeah.
So if we can't get through them.
Let's go lightning round with this one.
Okay.
Around the table. Where do you see inflation going, and what industries could be challenged in 2023?
Okay, Jared, we'll start with you. Yeah, I think inflation will continue to go up until they, it will continue to go up. Interest rates will continue to go up. I think it will finally kind of normalize sometime the middle part of next year, would be my 2 cents and from what I'm reading, but we'll see. Everyone's got a different take, but
Okay.
I think there's a recent survey, Bank of America came out and said 92% of fund managers saw stagflation next year. So I think that's my perspective. In terms of the industries that could get hit, I think retail could potentially take a big hit. I would be concerned there. Things that touch the consumer would be the things I would be the most cautious about.
Okay, thanks, Jared. Ali?
Yeah, I think that from a standpoint of CPI, when people talk about inflation as core, inflation by formula, I think we might have seen that peak just here recently because we had such a big spike. However, I think we're going to continue to see inflationary trends, maybe not at the same level that we've seen recently, but still continuing. To Jared's point, I think retail is ready for a big hit. What happened post-COVID, and let's just pick on one industry. Let's just talk about home improvement. People building pools in your backyard or doing renovations for the house. There was a ton of demand in a very short period of time, and that made prices spike. And what's happened since is demand has slowed, and those prices haven't necessarily come down anywhere near as much as they went up. And as competitors come in the marketplace, and retail is a great example, as other businesses come in and go, hey, we can deliver this without having this massive markup price, it's going to take a little while for those prices to come back down. But there will be there will be competition that will bring prices down. So in short, I think we'll see inflation continue. It might get a little bit worse from a standpoint of general consumption, not CPI, but services you're consuming. You may see prices go up in the future for the reasons I mentioned earlier about the employment and wage issue. But I think it'll get a little bit worse and then we'll get better from there. But from a core inflation standpoint, I think that we've peaked. It's, as far as we've hit the highest inflation rate that we'll probably see.
Thanks, Ali. And Walter?
Here. Yeah. This is just my feeling on interest rates. I kind of feel like we have peaked on the interest rates. I think that there's just the sentiment around this conversation, though. They talk about, you're reading more, it seems to me, or more people talking about bad headlines than good headlines. I think it's very much weighted towards the bad headlines. And so while interest rates may have peaked, I think some of the other uncertainty is going to kind of stay in the market to do that. So I don't think we're going to see a big downward trend. What I would add to maybe markets that will, or segments, industry segments that I think would get hit, or I'm going to say commercial construction. I think residential construction got hit first. That's a much shorter cycle about doing that. But I think a lot of the projects that are going on right now in building trades are on projects that were, started in some cases 24 months, 36 months ago. And I think now as interest rates have gone back up, some of those planning for projects Those bigger capital intensive projects have slowed down. And so you'll start to see kind of less and less of those happening. And then that can trickle down to, if you're in a, trade business, commercial trade contracting, I think you'll start to see some kind of decreasing of revenues and good times slowing down those markets.
Well, very good. I've been given the high sign that we're coming to the end of our discussion. We didn't get to everybody's questions, but thank you for submitting those. And I want to thank the panelists for joining us. Let me put the panelist contact information up on your screen. Just so if you want to get in touch with any of us, you can take a screenshot. We'll also send this out to you in our follow-up email. But really and truly, thank you, Ali and Walter and Jared. Your insights and experience have been very helpful. In conclusion, I guess the way I think about it is really and truly at the end of the day, life and business is just a compilation of highs and lows. But it's in the lows where the magic really happens. Those are the moments where we really build character, where we experience great breakthroughs. When you look back at the years, maybe even decades from now, I think those will be in your diary that said, that was the moment that I remember. That was the moment that I broke through. So I guess in conclusion, my advice is embrace the struggle, if there is one, and leverage this time of uncertainty and challenge to unlock new opportunities, not just in your business, but in your life. Thank you very much, and I wish everybody a great day, and we'll be following up with you with our recording. Please give us a call if you want some help with your 2023 business plan. You can call my firm. Our toll-free number's up there. We'll be happy to give you a 1-hour free consultation. If you want to know more about selling your business, give Walter a call. If you're looking for a purposeful, driven investment advisor, he's more than an investment advisor, get to know Ali, give him a call, reach out to him. And I really want you to get to know Sunflower Bank. I mean, they're a great family institution, great lender, and they've got terrific people like Jared there. So reach out to any of us if we can help you in your 2023 planning. Thank you all very much, and have a wonderful day.